Hey everyone, welcome to episode 79 of the Julia LaRoche Show. We have a returning guest to the show. We are joined by Brent Johnson. He is the founder and CEO of Santiago Capital. He is also the investor behind the Dollar Milkshake Theory, which is a framework he developed to help explain how a sovereign debt and currency crisis might play out. In this episode, we revisit the Dollar Milkshake Theory. We also got Brent's macroeconomic outlook and why he expects the Federal Reserve's rate hikes will really start to pinch the economy in the second half of the year, and why we will likely see downside in risk assets. We also got his outlook on the US dollar, especially amid all of these headlines around de-dollarization. We got his take there. We also got his take on gold. He has been a long-term believer of gold, and of course, much, much more. I really enjoyed having Brent back on the show. I always learn something from him, and I think you will too. By the way, if you're new to the channel, welcome. So great to have you here. If you haven't done so already, please be sure to hit that like button and ring that notification bell so you won't miss any future episodes. And if you're listening to the podcast, if you feel so inclined, please leave a rating and a review so you can help more folks find these episodes. I really appreciate your support. I couldn't do this without you, and I hope you all enjoy this conversation with Brent Johnson. Brent Johnson, founder and CEO of Santiago Capital, a wealth management firm headquartered in Puerto Rico, and also the host of the Milkshakes, Markets, and Madness show. It is great to welcome you back on the show. Really great to see you again, Brent.
Yeah, thanks for having me. I'm looking forward to talking to you.
Likewise. And I have to say, you were on episode 22, and this is going to be episode 79, and you were a huge hit with the viewers. So I'm excited to have you back on, especially with everything happening of late. And I think where I'd like to start is where I usually go with my guest, which is the big picture, the macro view, more of your framework, how you're viewing the world today. Let's start there.
Sure. Well, I've kind of had the same macro framework for probably 3 or 4 years now. And while it hasn't played out exactly the way I thought, it hasn't been incorrect. And so it's helped me navigate the last 4 years. And it's helped me kind of understand why things happened the way they happened and where I think they're headed. Now, whether they will end up the way I think they will or not, that time will tell. But the framework has helped me over the last 4 years. And the framework has really been what I've dubbed the Dollar Milkshake Theory. And for anybody who's followed me is probably sick of hearing that phrase. But it has really helped. And for those who are not familiar with the theory, it's basically, I have said that I think that we are headed towards a sovereign debt and currency crisis. And when that happens, I think that the US economy and the US dollar will be seen as the safe haven. And even though it has numerous problems on a relative basis to other places that people can put their money, I think they will choose to put it in the United States and in the United States dollar. And so we have not had the currency crisis yet, but capital flows have continued to come into the United States. Our equity markets have dramatically outperformed all the other equity markets. The US dollar has outperformed all other currencies over that time period. And I also say I'm also a big long-term believer in gold. And over that same time period, gold has gone higher. And so, when we got last year, when the Fed started raising rates and the dollar got stronger, I wasn't surprised by that. It kind of helped me kind of navigate the storm a little bit. And I think we're going to have more of the same going forward. The Fed has now been raising rates for a year, a little over a year. I think as we get into the back half of the year, all those interest rate hikes are going to start to pinch the economy, for lack of that's probably a polite way of saying it. And I don't think it's going to be like the first 6 months here. We've had a little bit of volatility in March when we had the banking issues, but since then, volatility has remained relatively low. We haven't had a lot of excitement other than things just kind of grinding sideways and up a little bit. But I think when we get into the second half of the year, I think we're going to have some more excitement, probably some more downside in risk assets. And whether we hit the recession wall or not, I don't know. We'll just have to wait and see. But I think the odds are increasingly likely that happens.
Yeah, that's a great just kind of framework and outline even for this conversation. I know, Brent, you probably are tired of explaining the Dollar Milkshake Theory, but I'll say, okay, some folks can go back and listen to episode 22 with you, but for folks who are maybe coming to this channel or to the show for the first time, Can you explain it? And I know
Yeah.
you get the name from the movie There Will Be Blood, and I love the way you explain it. I actually started watching the movie. I have not finished. It's a long movie,
Yeah.
but I started watching it last night. So if you could explain
Yeah.
it.
Yeah. So the reason I came up with what I think is kind of a simple analogy is I've always worked with individuals in my career, and I've always tried to come up with kind of simple ways to explain fairly complex ideas or concepts. And in this movie, There Will Be Blood, it's about this ruthless oil executive, and he's negotiating to buy a piece of land next to his, and the guy really wants to sell his land to the other guy. And he says, if you buy my land, then you can have all the oil underneath it. And this ruthless oil executive says, I don't really need to buy your land. I can just stick a straw down on my side of the fence and I can drink your oil. He said, I can drink your milkshake. And I thought that's a good analogy for the dollar milkshake theory, because I think since the global financial crisis, which is now 15 years ago, hard to believe, but since then, the world, not just the United States, but the whole world has done a number of different liquidity injections, bailouts, government stimulus, however you want to define these extraordinary monetary policies, and they've added liquidity to the global economy. But I don't think, but in today's world with global capital markets, to me, it's not as important who prints the money. It's who captures it. It's who gets to drink it, right? So this whole world has been mixing this milkshake of liquidity. But I think for several reasons, the United States has the straw, or at least has the bigger straw than everywhere else. And so, right now, the U.S. has been tightening monetary policy. Maybe it's possible that they're going to have to go back to easy monetary policy. And I think they probably will. And I think much of the rest of the world will have to as well. And so when that happens, for many reasons, I think the U.S. has the straw and will be the main economy that sucks up that liquidity again. So that's kind of the thesis, is that we're going to get into this global currency crisis, a global debt crisis. The response from central banks and monetary authorities will be to print more money, to inject more money, to do more bailouts. And as a result, I think whoever captures that liquidity is going to, on a relative basis, be better off. And I think that will be the U.S. Now, that's not to say that it's going to be great in the U.S. It doesn't mean that we don't have problems. It doesn't mean it's going to be easy. I just think, again, if you had to choose where to go, I think that's where most global investors will choose to go.
Yeah. And I think one of the keywords I'm hearing from you is relative, like on a relative basis. And this isn't necessarily like some great, amazing scenario that plays out. This would actually probably mean this would probably be it's a pretty dark scenario, if you will.
Yeah, unfortunately, the first time I ever, and coming up with this it's been a process. It's kind of developed over time. But the first time I ever kind of started speaking about it was 2018. And in the very first interview I gave, where I started to lay out how I thought things would play out, one of the very first things I said is, this is not a story that ends well. And I think one of the reasons, I think, in the times that I have gotten pushback on the theory, I think one of the reasons is because people wrongly assume that I think that this is going to be a good thing for the U.S. And I don't necessarily think that. I think while we will have some benefits as a result of it, there's going to be negatives as well. And the idea that a global currency crisis is quote unquote good for anyone, I think, was a stretch. So again, it's, a relative win, it may be the best result. It doesn't mean, and so the theory will often get described as the cleanest dirty shirt, analogy.
Yeah.
And they'll say, who would want to wear a dirty shirt? And my answer to that is, well, nobody wants to, but if you had to choose, wouldn't you prefer the cleanest dirty shirt? I mean, would you rather have the dirtiest dirty shirt? And, global investors, the investors that move big blocks of capital, they can't just go sit on the sideline and put it in cash. You as an individual investor, we could just, cash out, sit in cash. Maybe we buy a little gold and just wait for everything to blow over. But the big asset allocators, they can't do that. They have to put their money somewhere. So when you consider that, it does become a relative game. And they're going to put their money in risk assets. It's just a matter of where they're going to put them. And that's why I think the U.S. will get the lion's share of them.
Yeah. You mentioned the first time you laid out this theory was in an interview in 2018, and as you said, it's a story that doesn't end well. Has That's okay. That's five. It's been five
Yeah.
years. Has there been anything that's maybe changed your thesis, or has the theory evolved a bit? Just curious,
Yeah.
yeah, how that framework's
Well,
evolved.
so I'd say there's been a couple things that have changed. And here's the other thing is like, I don't mind saying that things have changed, because anybody who thinks that they're going to predict the future and get it 100% right is either just so arrogant that you don't want to deal with them, or just a, total psychopath. And so, when we got into 2020, we thought we were really on the cusp of a crisis. And then COVID hit, and we thought that COVID was probably going to be the catalyst to cause this currency crisis, or to cause this sovereign debt crisis. And in hindsight, we got that wrong. And the reason we got it wrong was that because COVID was, for the most part, seen as kind of a globally systemic event, or a global event, it wasn't just one part of the world that was going through it. The whole world sort of, maybe not 100%, but for the most part, cooperated. There was a commonality in monetary policy. There was commonality in health, national health policies. There was a commonality in social programs. And so the world kind of worked together to get over it, right? Or to get past it. And as a result, they were able to kick the can down the road on these problems. But since then, what has happened? Well, so that's why I think we got the timing a little bit wrong. Mm-hmm. But what has also happened since then is that subsequent to that, now the world is no longer cooperating. And in many ways, the world is fracturing. We probably had 2 or 3 decades of globalization, and I think now the pendulum is swinging the other way. The conflicts between, the East and West, China and the United States, China and Russia, Russia and Europe, however you want to define that. I think those are higher now than they were a couple of years ago. And unfortunately, I think those are going to continue to bubble up, and as opposed to get better. And so what has changed is, I think, unfortunately, I hate saying this, but I think, more military conflict is probably coming. And so that's obviously not good for anybody, right? And even though I think the US has the biggest military and probably the best position to fight a war, should it come to that, nobody wins, right? It's just a matter of who loses the least. And so I think the fracturing of the global economy is what's changed a little bit. When I first started talking about it, I thought there would be a crisis, but I didn't necessarily think there would be military conflict as a result of it. It looks like that's where it's headed to me. Again, this is the case I would absolutely love to be wrong. So I will happily, 5-10 years from now, if we haven't had a big military conflict, I will happily raise my hand and say I got that completely wrong. Mm-hmm. And so then the pace with which rate hikes took place has been a little bit of a surprise to me. I thought that they would raise rates, and I thought the US would be able to raise rates more than the rest of the world. I did not expect Powell to raise, 5 or 6 times in 1 year, and to get to 5.5% in a little over a year. I mean, that's pretty amazing.
Yeah, it is. It's interesting too, like just listening to you, like when you have like a framework and a thesis and like kind of like a narrative too, and I like that you say, hey, I'd be happy to be wrong here. It's just, I think it's just kind of fascinating to like hear like, okay, so there's a framework that you kind of look at the world, and of course no one knows like what's going to happen, but it probably is, I imagine, really important to have some sort of guiding framework, especially as an investor.
Yeah. And, last year really kind of solidified our thesis, for lack of a better way of saying it. Coming out of COVID, the U.S. was kind of the most aggressive on easing monetary policy. And so from, the heights of COVID to summer of 2021, the dollar pulled back from, 102 to 90. And a lot of people were saying that the Fed would never stop printing. They'd never stop sending checks. COVID would be here forever. They would always do stimulus, and the dollar was headed to 80. And we stood pretty firm and said, no, for a number of reasons, the dollar is going to go back higher. And not only did it go back higher, but over the subsequent, year and a half, it went from 90 back to 115, which was a 30-year high. Mm-hmm. And when a lot of people were struggling to understand how it was possible that the dollar was rallying despite all of these problems that the U.S. has, it made a lot of sense to us, and it showed us that while we're definitely didn't have everything right, we weren't totally off base either. And that's why we think that the subsequent pullback in the dollar now over the last I guess it's almost 9 months now, it's been pulling back, and it's pulled back about 10%. It's not surprising to us that it's pulled back, because we've always said we can be wrong, but we understand why it's pulled back. It's pulled back largely because the expectations for further rate hikes has fallen, and we think that was a big reason why they were rising to begin with. But we've never said it's only because of rate hikes. We think there's a number of reasons that could push the dollar higher. And so even though the dollar's pulled back, and we understand why it's pulled back, we think that probably the biggest risk out there that is underappreciated is that the dollar could go back up again. And I think, with the pullback that it's had, I think there's a lot of people out there that are now expecting an imminent pivot by the Fed. They're going to stop raising, and they're probably then they're going to cut rates, and then they're going to go back to QE. And so therefore the dollar is going to go lower. And that, I can't rule that out. That could happen. But what we would say is that will happen to every other country as well. ECB will have to do it. Bank of Japan will have to do it. China will have to do it. Australia will have to do it. And so on a relative basis, we think the dollar will rise again, just like it did, last year. And so, or at least we think there's a higher risk of that happening than the market is pricing in. Yeah. And when the dollar goes higher, really bad things happen. That's why we had a lot of volatility last year. That's why markets were down so much last year. That's why, the Bank of England, the Bank of Japan, the ECB, they all had to intervene in their sovereign credit markets last year to kind of keep things going. And that was because the dollar was getting stronger. And so we just think that in this type of environment, you can't ignore that. You have, as somebody who manages money of other people and who's a fiduciary, when I see a problem of that magnitude that could show up and impact people's portfolio, I can't just ignore it. I don't necessarily have to bet 100% on it, but I can't ignore it.
Yeah, can't ignore it. As you point out, that's one of the biggest risks that you see is that the dollar could go higher. And, you just kind of point out that's what impacted markets. We saw all these central bank actions last year. Can we explore that or flesh that out? Like that risk in particular, and maybe what do you think could push it to go higher? What are some of the catalysts?
Yeah, so last year, what we think caused it last year was the aggressive rate hikes by the Fed. So on an interest rate differential, you got paid more to put your money in dollars than to leave it in euros or yen or yuan or whatever it was. We think it was probably done mostly for domestic inflationary reasons, but we also think that the Fed and the U.S. government, we think they know that there was knock-on effects of doing that, and that is that it would put extreme pressure on the rest of the world. It basically put recessionary pressures on Europe, same in Japan, same in China. And in many ways, we think they were doing that on purpose to kind of shore up their side of the geopolitical landscape, right? If you put somebody under pressure, you can then get them to negotiate with you, perhaps negotiate more favorably for you. And then they could say, listen, we will help you out, but you're going to vote with us on this UN resolution, or you're going to be on our side when it comes to this trade agreement. So we think that the US knows how to use the dollar, quote unquote, as a weapon, right? And so that's why we think it was done last year. And as we go forward this year, while we don't necessarily think they're going to continue to raise rates at the same rate as last year, I do think that they will raise rates in June. And I do think there is a higher likelihood that they continue to raise than many people. I also realize that once they hit the wall and credit stops getting extended, then we could have a credit crunch. So what I mean by that is, for the economy to function, capital has to be circulating. Based on the design of the system, capital has to circulate. If capital stops circulating, then interest doesn't get paid, debts don't get paid, and then we start to have these, a debt crisis, which is what we have long foretold. If that starts to happen, if people stop spending money, if transactions stop happening because now rates have gotten too high, then we could have starting to having defaults. And once defaults happen, then you have supply of money starts to disappear. And when supply of money starts to disappear, then you start to have layoffs happening. And then when layoffs stop happening, then you have spending to start to fall. And so that could start the downturn. And typically in a downturn, there's a lack of supply of dollars, and then that pushes the price higher, not because things are great, but just because lack of supply, right? And so even if the Fed stops raising interest rates, or even if they start to cut rates, if the supply contracts even faster than that, you can still get a price rising. And the issue is that it's not just the United States that owes dollars. So the US owes around $31-32 trillion. Well, the rest of the world also owes over $30 trillion, and they owe it in dollars, and it's not their home currency. So they have to go out on the market and buy dollars to then service their dollar debt. So if dollars start to disappear, basically when we tighten monetary policy and dollars aren't as plentiful, it makes it harder for them to service that debt. Now, the fact that the dollar has come back down 10% has made it easier over the last 6 to 9 months to service that debt. But if we get into a situation where the global economy starts to slow and transactions start to slow, and then you start to get some defaults and the supply of dollars starts to contract, then you get a situation where the demand is still there because debts still have to be paid, but the supply of dollars is just not there to meet all that demand. Then you get a rising dollar in that scenario. And then, so that's one reason. And then the other reason is, as I talked about, the increasing geopolitical concerns. If the war in Ukraine, unless if it doesn't get better and instead it gets worse, I think increased military tensions, or God forbid something happens with the U.S. and China, whether it's over Taiwan or some other issue, that's typically a time where you get a flight to quality. And, because everybody needs dollars to operate, you can see the dollar rise higher on that scenario as well. So again, whether these things come to pass or not, I don't know. I just think there's a higher likelihood of them happening than is currently priced in. And it's something that I have my eye on very closely.
Yeah, certainly something that you have to pay attention to or think about, especially like as someone who you're managing money and client money and being a fiduciary. Okay, so I do want to ask you this, because when I'm listening to you about like a fracturing global economy, it kind of brings up to this notion, and I'm sure obviously you've seen all the headlines around this de-dollarization narrative. I would love to hear what you think of it. What do you make of all this?
Well, I don't ignore it. I think a lot of times, because people know that I'm very bullish long-term on the dollar, they think that I don't see these things happening, or I don't admit that they're happening. But I absolutely admit that they're happening. And part of the reason that they're happening is because of what happened last year. And what I mean by that is, when the world needs dollars to operate, and you get into a situation where the U.S. I need to take a step back and explain to people how dollars get created to begin with. Mm-hmm. Okay, so I'll make this very simple, but there's the monetary base, which only the U.S. government can create, and that's the reserves, that's dollar reserves and printed currency, any physical currency or coins, and then reserves that are at the Fed. That's the monetary base. All of the money, all of the dollars in the world gets loaned into existence. Okay, so there's the US dollar market, but then there's the euro dollar market. And euro dollar market is the dollar market that exists outside the United States. The only way that dollars gets created in the euro dollar market is by the extension of credit. Somebody makes you a loan, all of a sudden you've got $1 million in the bank. Or they extend credit to one of their vendors, and their vendor can then buy or buy the inventory on that credit. But they're basically creating money out of thin air by making loans. If that stops happening, and that's what I mean, if money starts to get tight and that nobody wants to make any more loans, then the supply starts to contract. And so when that happens, it becomes harder to pay your debts. And so when we go back last year, a number of countries around the world could not meet their dollar obligations. And it was all over, whether it was Ghana, whether it was Bolivia, whether it was Turkey, even Europe and Japan and other places, they were very under pressure because we had a combination of commodity prices rising because of the supply issues. And then not only that, but commodities trade on the global stage in dollars. And the dollar was rising versus another country. So as an example, if you live in Turkey, and in Turkey, inflation was 80%. And then let's say you manufacture shoes. You live in Turkey and you have a shoe manufacturing business, and you had $1 million loan in dollars that you used to build your factory. Well, now, and you have to buy the inputs for your shoes, those prices are up, and those are priced in dollars. So they're up 10% or 20% because the prices are up, but then also your currency is down 10% versus the dollar. So instead of the prices being up 10%, they're actually up 20% in your local currency terms. So that's why the dollar going higher is so hard for the rest of the world, because it's not only that prices are going higher in your local currency, but you have to go get the dollars to then service the dollar debt and to buy dollar-based commodities. And so it's kind of and that's why having the global reserve currency is such a big weapon for the United States, because then that's why I said earlier, when they raise rates, they can put the rest of the world under pressure. That is why when they raise rates, they make the dollar stronger versus these other currencies, and it makes them harder to service their debts and to operate in dollars. And so that's what was going on last year. And so that's why it's so important to understand the dollar, because the dollar influences every part of just about every economy around the world. You just really can't get away from it. And so this, coming back to your question, why is all this de-dollarization taking place, is because the other countries, they recognize this. They recognize that they're kind of slaves to the dollar system, and that the US can put immense pressure on them. So they're trying to figure out, how do we come up with a system that doesn't use dollars? And what I would say is, I totally get that they're trying to do it. I completely understand why they're trying to do it, but it's just really, really hard to do it. It's not that I don't see the effort, and it's not that I don't understand the desire. It's that I think better than most people understand how hard it is to actually do it. I've jokingly used the analogy that, I've had a plan to join the PGA Tour for 20 years, but it's really hard to do. You can't just say you're going to do it. You actually have to go do it. And there's pain involved in doing it. For any country to de-dollarize, it would put their economy in immense pain. So they're in pain if they stay, and they're in pain if they lose. But the short-term pain of them leaving is even more than the short-term pain of them staying. And so for them to actually be able to completely de-dollarize and not go into crisis doing it is incredibly difficult. And so that's why I've said, is even if de-dollarization does happen, and even if it continues to happen, and there actually is some implementation of de-dollarization rather than just a headline, the process of de-dollarization is very painful. And in that painful period, I think the dollar actually goes higher rather than lower, which is if you can get through it and get to the other side, then that would be very bad for the dollar. But in the short term, going through it, I think is actually good for the dollar, because the process of de-dollarization is kind of a chaotic and volatile process. And typically, if you look back over the last 25 or 30 years, whenever there's economic turmoil or volatility, the dollar rises. So it's kind of it's really I don't know the right word to use it, but it's one of those traps that the more you fight, the tighter the trap gets. And so it's really, really hard to escape the trap.
Yeah. And just for folks who are watching and listening, you mentioned the euro dollar system. On episode 67, you can listen to that conversation with Jeff Snyder, and we did a deep dive there. Still very much a black hole to me. I'm trying to wrap my mind around it, but I think you did a really nice job of framing it up. Let me ask you a quick follow-on, because it's more of a curiosity. I was taking a bunch of notes. You're talking about like how dollar as a global reserve currency has been kind of weaponized. Raising rates can put the rest of the world under pressure, making it harder to service their debt and operate in dollars. So could it also like backfire on the US? Like, imagine there's a lot, like many folks or many other places might not appreciate all the rate hikes and whatnot. There's a risk. You have to kind of like walk a fine line, I suppose.
Yeah. So the short answer is yes, there absolutely can be a blowback. So I can tell you, so last September, at the end of September of last year, the dollar was at a 30-year high. The VIX was at a 2-year high. Equities were at a 2-year low. This was when the Bank of England was intervening in their market. The Bank of Japan was intervening in their market. China had been, doing measures to kind of help their real estate market. So the world was under a lot of pressure as the dollar was high last September. And in early October, so like a week or so later, I was in DC meeting with some people who were kind of in position to know kind of what was going on behind the scenes. And they made it very clear to me that policymakers in the United States were getting calls from their colleagues around the world saying, what in the hell's going on? You guys are killing us. You have to take your foot off the brake. The strong dollar is going to cause a huge crisis. And they were getting these calls not just from our enemies, but our allies as well. So it wasn't just, so the point was the whole world was under pressure. It wasn't just Russia or China. And so when you get put in a position like that, you have to kind of come up with countermeasures, right? And I think that's largely what we've seen this year. We see the rest of the world trying to come up with countermeasures. And so that's why I think you've seen all these, de-dollarization headlines. And I think at some point down the road, they will be successful. And a lot of it is because they've seen what can happen if they don't do anything. If they're trying to protect their citizens and their countries and their economies, they can't just play along. They have to try to come up with some alternative way to operate in the world. And so I understand why they're doing it. But what I would say is it's just, again, I bring it back to it's much easier to say than to do. And that's why I feel like a lot of times when I talk to people who disagree with me, they are speaking from a point of what people would want rather than what they can actually do. Of course, they want to de-dollarize. Of course, they want to get out from underneath the thumb of the United States. But wanting to do something and having the ability to do something are two completely different things. And I just think the road to getting out from underneath it is much, much harder than many of the proponents of the de-dollarization process. And I think it's, a lot of times you will see these headlines that we're going to de-dollarize and we don't understand why we should be using the dollar. But then, Ghana is a very good example. So Ghana is a country in Africa who was, they had an extreme dollar shortage. They were having trouble getting dollars to then buy energy, whether it's oil or natural gas or diesel or whatever it was, because you need energy to run your country. No matter, every place in the world needs energy, and because energy trades in dollars, they needed dollars to get energy. And so they, over the summer, or not over the summer, a couple months ago, they have a gold industry, and they said, we are going to use the gold from our gold mines to buy oil. And the idea was they would not need dollars anymore. They could buy the oil with gold. And since they wouldn't have to use gold to buy energy, since they wouldn't have to use their dollars to buy energy, then that would free up some dollars and allow them to use those dollars elsewhere. That lasted about a month and a half or 2 months. And then they just agreed to get another bailout from the IMF in dollars. So again, they came up with a plan and they tried, but it ultimately failed. And now they're back to having even more dollar debt than they did before. And they're still using dollars. And so even though they tried to de-dollarize, it wasn't successful. Another example is back in 2019, there was a big headline that Iraq and China were Iraq was no longer going to sell oil to China in dollars. They had agreed to a thing where it was going to be an in-kind deal where Iraq would provide oil to China. China would then provide services, infrastructure building, kind of helping them grow their economy in exchange for the oil. And everybody said, oh, see, here's another example of de-dollarization. The dollar is no longer being used in energy markets, and China's the biggest buyer in the world. Well, and it was hailed as this great revolutionary thing. Well, the reality is that deal only covered about 10% of Iraq's oil exports to China. So it was a very small piece. And then it was never actually implemented. It never actually happened. So, again, the difference between the headline and reality was massive. And I think that's a lot what that's why I still think over the next couple of years, the dollar is going to go a lot higher, because, the headlines, in my opinion, just don't match reality. And another analogy I would use is, let's talk about the green energy initiatives. I think everybody knows that there's been a big push around the world to, go green in order to fight climate change, and governments around the world have instituted mandates and policies and, offered stimulus to certain companies that would try to get away from carbon-based energy and go to green-based energy. And that's great, and Europe was kind of leading that charge. And, that's great. But it takes a while to go from a carbon-based energy to a green-based energy. And what happened last year was that we had a crisis where traditional energy spiked before the green initiatives were ready to go. And so Europe was put in a big squeeze last year as their natural gas and oil prices went through the roof, because the whole continent still needed traditional energy to run. Even though they wanted to go to green, they were still using traditional. And it's the same thing, in my opinion, with de-dollarization. They want to go to a non-dollar based trade, and they're putting initiatives together to do that, and they're building systems to allow them to do that. But in my opinion, there's going to be a crisis before those are fully implemented. And just like traditional energy prices spiked, I think the dollar will spike. And so, it's very important to understand that the world wants to de-dollarize, and it's important to understand that they're making efforts to do it. But I always recommend to people, don't confuse desire with ability, because they're two dramatically different things.
That's a good mental model. Don't confuse desire with ability, and interesting analogy too to energy and the need for fossil fuels to get to a green future. I want to bring up another topic with you. And gosh, we are recording here. It's Thursday, May 25th. It's 1:35 p.m. Eastern for the folks watching and listening. Although I don't know when it will get edited and distributed, but the debt ceiling negotiations.
Yeah.
Anything can happen, I guess, before this episode even goes live.
Right.
So I don't know how to frame this up, but maybe we'll just do a more open-ended, how are you thinking about it? Maybe short-term, long-term. What are your general thoughts?
So I think about it in two different ways. I think about it in short-term and long-term. And I think it's really, really important for retail investors who perhaps don't do this every day to understand this. And that is that, first of all, the debt ceiling will get raised. And the reason it will get raised is both sides want to spend money, right? I'm not going to get into the Democrats versus the Republicans too much, other than to say, there's obviously differences, but where they have a great similarity is they both want to spend money. So the idea that they're not going to raise the debt ceiling so that and not be able to spend money and not pay their own salaries, it to me is a little silly. It will get raised. The question to me is how much chaos goes on between now and then. I think that Janet Yellen had said that, by June 1st, we're going to run out of money. Over the last kind of 24 to 48 hours, I think that date's been pushed back a little bit to maybe to mid-June. But I think both sides will, again, headline versus reality. The Republicans will come out and say the Democrats would rather have a government shutdown than do the right thing. And the Democrats would come out and say, oh, the Republicans are being unreasonable. They want to cut funding for Social Security. And, so that they want to score their political points with their base prior to raising the debt ceiling. But I think ultimately it will get raised. Now, here's where it gets more interesting for me, is in the short term. Now we'll talk very short term, and then longer term. Very short term, if they were to come out today and say there's a dollar we're raising the debt ceiling, there's a solution, I think markets would probably rally initially on that euphoria, and dollar would probably pull back a little bit on that. But if we fast forward a week or 2 weeks, what would happen, I think, is that if they raise the debt ceiling, I think if they raise the debt ceiling, it means that the Treasury can now go out and issue more debt, right? And in the long term, that's bad for the dollar, right? If you take on a bunch of debt that you can never pay off and you have to print a bunch of money to pay off that debt, then that's going to be bad for the currency. So for those who think raising the debt ceiling is bad for the dollar, in the long term, I agree. But in the short to medium term, what that means is that now the Treasury can go out and issue more debt. But when they do that, they're exchanging their debt for dollars. So they are going back into the market and they are draining dollars from the market and putting it in their checking account. So if you've read anything about the debt ceiling and you've heard the word TGA or the three-letter acronym TGA, it stands for the Treasury General Account. So just like you and I have a checking account at a bank, they have the government has an account at the Federal Reserve, and it's called the TGA. So if they go out and they sell bonds, then people give them dollars in exchange, and they put those dollars in the TGA. So that TGA is getting lower and lower and lower. Their government's running out of money. When they raise that debt ceiling, they are going to want to replenish that TGA account. So whereas over the last 6 to 9 months, it's gone from like 600 billion down to 60 billion. That money's gone into the economy. Now they're going to want to build it back up to 600 billion. So they're going to take that money out of the economy and put it back into their account. So that would be a drain on liquidity, which in my opinion would not be favorable for risk assets or for the stock market or for the economy in general, because all things being equal, less liquidity means more risk, more liquidity means less risk. So that's why I say it'd be kind of interesting that if they raise the debt ceiling, it can actually be a net negative for the stock market, even though that debt ceiling risk has been taken off the table. So my point is that over the summer, I think whether they raise the debt ceiling or whether they don't raise the debt ceiling, it's a net negative for liquidity. Now, that doesn't necessarily mean we're going to have a big crash. It just means that all things being equal, less liquidity is bad than it is good. And so I think over the summer, I think we could have some volatility over the summer, regardless of whether they raise the debt ceiling or not.
Yeah. The liquidity part, that's an interesting part to bring up, that, no matter what they do, it's the scenario is less liquidity, as you put it. Let me just ask another question, because, okay, I feel like this keeps coming up over the years, this come up. Is this just going to be like a natural thing? Like, this is just going to always happen. We'll always have these kind of like showdowns every so often there'll be some sort of showdown, and okay, raise the ceiling. Is there ever going to be like a day of reckoning where it's like,
well, I think there will be. I think there eventually will be. I happen to think that it will be after every other country has their day of reckoning. So, and it kind of goes back to the whole milkshake theory and the clean is dirty shirt. I fully recognize and acknowledge the incredible problems that the U.S. has gotten itself into, by the amount of money that they've spent and the fiscal policies that they've implemented. But because the system runs on dollars and because the whole world runs on dollars, it almost necessitates that everybody else goes into crisis first. Now, nothing is guaranteed, nothing is for sure, but just all my analysis tells me that there will be a progression where other countries will go into crisis before the US. And again, we saw that last year. We saw Europe was in crisis. We saw Japan was in crisis. England was in crisis. China was struggling with their real estate market. And so I think that started to play out last year. And I think in the future, you'll see that play out again. But I do think that, unfortunately, we probably will have these every couple of years, these debt ceiling showdowns. And, like it or not, I think that's the way politicians kind of score their political points and raise political capital. And they get to, stand up on the floor of the U.S. Senator and shake their fist and say these darn Democrats and these darn Republicans. And, but ultimately they will get raised because they both want to be able to spend money.
Mm-hmm. Let me also bring up with you, because I was just listening in the conversation again, taking it. Since always great to have you, because like my notes just fill up because you have a lot of great knowledge. I heard you say that you expect a rate hike in June, and I think I did hear you on your own show say that, and I think many folks now expect that. Would love to just kind of hear your thoughts. Like, why is the Fed why do they keep hiking at this point,
Yeah,
especially in light of like the regional banks, the
sure,
crisis there? Just a
sure.
curiosity.
Well, I wish I didn't have to say this, but I think a lot of it just has to do with Powell's personal legacy. And you've probably heard other people bring this up. But what I mean when I say that is that so central bankers are nothing if not arrogant, in my opinion. They think they're the masters of the universe and they don't like to get things wrong. Unfortunately, coming out of COVID, they printed a lot of money, for lack of a better way of saying it. And they said inflation would be transitory, and it turned out not to be. And it turned out to be much bigger than they thought it would be. And as a result, the Fed lost a lot of credibility, a lot of political credibility, and a lot of personal credibility. The individuals themselves, Powell, Brainerd, some of these other the Kashkari, their personal reputations took a hit as a result of that. And I don't think Powell wants to go down as being a bad central banker. And if he raises rates now, he can say, and by raising rates, if the stock market comes under pressure, it doesn't hurt the everyday guy on the street so much. And he's getting paid more on his savings account at his bank or in his treasury bills. So from that perspective, the political points kind of go in Powell's favor. The next thing is if he were to pivot, or if he were to pause, or if he were to, God forbid, cut rates, and then for whatever reason, inflation doesn't keep coming down and it starts to go higher again, then he's going to look really, really stupid. He's going to look like not only did he get the call on inflation wrong to begin with, but now he cut too soon and inflation is going to take off again. And now he's going to be double behind the curve. And I don't think he's willing to let that happen and have him go down being a laughingstock. So if he continues to raise rates and the economy slows, which it is, you can see in the numbers that the economy's slowing, and he probably should just stop at this point. But I don't think he will, because if he keeps raising and then something breaks, or if we get a big downturn, then everybody will be begging him to pivot. And then he can pivot with no risk. So I guess my point is, if he pivots now, even though, you might think the risk is small, there is risk there. And if he pivots too soon and inflation doesn't fall, then he's kind of sealed as an Arthur Burns. And Arthur Burns was the central banker back during the 70s, during the high inflations. Yeah. And he's often, whether it's correct or not, he's often referred to as an ineffective central banker. Yeah. And then Volcker came in after him and, got inflation under control. And he's often seen as a hero. And so I think that Powell would much rather be viewed as a Volcker than be viewed as a Burns. And so I think he'll continue to raise rates. And if he does continue to raise rates, and this is my thing with central bankers is, Jeff Snyder and I, we agree on many, many things. The one thing we disagree on is he thinks that they're just totally clueless and stupid. And I think that they're extremely smart, but they're overly arrogant. And so it's my opinion, they think that if they raise and break something, that they're smart enough to institute some new policy and save the system. They actually think that they can manage this, this race car driving around the cliff. And I don't share that belief, but I think that they think that. And so I think that he's willing to keep raising rates. And then when he has to turn, he'll turn. And he thinks that he can save the system when that happens.
God. And a pivot would be cutting, not just pausing. It would be a cut. And now it's like, if something really breaks, we enter recession.
Yeah. And maybe they even have to go back to QE. Maybe things really break and the market's down 15% in 2 days. And, they go just like, maybe it's like a March 2020 type event where, because you remember in the late parts of 2019, 2020, they were talking about raising rates. And then all of a sudden they had to do an intra-meeting cut. And then they had to go back to QE like a week later, like massive QE. So, if something like that were to happen again, he will cut. Because, and this is the other thing with central bankers, I will often hear times people say, well, they shouldn't interfere. They shouldn't bail people out. Well, I get that maybe they shouldn't in a free market, but we don't live in a free market. And the whole reason that central banks were created in the first place were to interfere. When things get bad enough, their job is to come in and bail the system out. So to think that they won't pivot and won't bail things out when things get bad enough, I think is wrong. Having said that, I think that Powell is willing to let there be more pain before he bails it out than most people do. I think he's willing. I don't think it matters to him if the S&P goes down 15, 20%. I think he'd be okay with that. Well, he doesn't want the system to collapse, but I think he would be okay with the stock market coming down, having a slight recession. He doesn't want a massive recession. He doesn't want the Great Depression. But if we had if we had stock prices down 10 or 15, 20% and a small recession, and as a result, we got inflation back down to 3%, I think he would love that.
How about how about US banks, regional banks? Are they like symptomatic of this? Like what are your thoughts there?
Yeah. So I think the small regional banks are in a lot of trouble. And I think that there's going to be massive consolidation in that segment of the market. I don't necessarily think that the central banks are trying to make them go out of business, but I think they're okay. I think they're okay knowing that that's a side effect. And so what I mean by that is, as a result of them raising rates, a lot of these banks have been put under pressure because they bought bonds when rates were low. Now rates are higher. The bonds aren't worth as much. And if people start to pull their money out of the bank, they have to sell these bonds at now lower prices. And, they get this classic bank run. The way that they're going to pay for some of these bailouts is they're going to raise FDIC fees. So, and not only that, but with all the increased regulation for small regional banks, the cost of the regulatory and these FDIC fees is a much bigger piece, and it's much harder for these small regional banks to pay than it is for the big Chase Manhattan or Wells Fargo or Bank of America or whoever it is. And so I think we're going to see, as a result of this, I think we're going to see more bank failures. I think we're going to see more consolidations. We're going to see more FDIC bailouts. And 20 years ago, I think there was 14,000 banks in the United States, and now it's down to 4,000. So I think that trend will continue. I think in another 5 years, it's probably down from 4,000 to 2,000 or something like that. So I fully expect that trend to continue. I would be very careful if I had my money in a small regional bank. And then the sad thing is the small regional banks are really important. And the small and regional banks, they do the majority of the lending to small and medium-sized businesses. And small and medium-sized businesses are the heartbeat of the economy. And so, the last thing you want is if you're opening a small store in, North Platte, Nebraska, you don't want to have to call your banker in Chicago or New York, to get that loan, because he doesn't know where you live. He doesn't know you, he doesn't understand the local market. And so it just becomes much less efficient. And so I don't think this is a good thing, but I think this is reality. And I think it's where it's headed.
Yeah. And when I was listening to you at the beginning of the conversation, when laying out your framework, you were talking about like these rate hikes that you think they'll eventually, as you put it, pinch the economy, a polite way of putting it. And sort of right now we've been grinding sideways, but expect more excitement in the second half of the year and maybe some downside in risk assets. But I also heard you say that you are a long-term believer in gold. Can you share your views on gold and the context in which you like to hold gold within your portfolio?
Sure. So we own physical gold in our portfolio. I think everybody should have gold. Part of the reason you own gold is that if you just look at history over time, fiat currency loses value. They make more of it, as they make more of it, it loses purchasing power, and you can't make more gold. So gold tends to hold its purchasing power better than fiat currency. Gold has been used as some form of money or a monetary instrument for thousands of years. It just has a great history of holding value and being accepted all over the world. And that's part of the reason the central banks own it. If you think about it, all the biggest holders of gold in the world are central banks. There's a reason, right? And so I think if central banks are owning gold for some reason, then it's not a horrible idea for you as an individual to own gold. But I don't own gold in order to get rich. I own gold to kind of protect, as more as an insurance policy long term. And even though I think gold is going to go much higher in the years ahead, I don't think it's necessarily going to go to $5,000 overnight. Oftentimes when you talk to somebody, in the gold world, they will say, you got to own gold because they're going to print a bunch of dollars. The dollar's going to go into hyperinflation. All of your money's going to become worthless, and gold's going to go to $20,000. Well, I don't think we're going to have hyperinflation of the dollar. I think there's way too much demand for the dollar for that to happen anytime soon. But part of the reason you own gold is you just never know. And the other thing is that it's kind of it, because I think we're going to get into this global sovereign debt crisis and the monetary system itself will come under question. I think gold will put itself forward as a possible solution. Now, I don't think we're going to go back to a gold standard, but if you see gold going from 2,000 to 2,500 to 3,000, while traditional money and sovereign bonds are under pressure, people are going to start looking at it a little differently, and it will become an option. And so that's part of the reason why I own gold.
Yeah, as you put it, like insurance. How about cash? How do you think about like how much cash you want to have? I guess to give you some optionality.
I think everybody should have cash. Exactly how you own that cash and where you own it, I think it kind of depends on your personal circumstances. But for years and years, basically for most of them, well, not my whole career, but from, let's call it 2008 until 2019, every time I went to a conference, every time I listened to a presentation, one of the things that got brought up was that rates are so low, there's no yield, you don't get paid anything for being in cash, and you got to go way out on the risk return scale in order to get any kind of yield. You had to go 20 years out on a bond in order to get 2 or 3% or something. Well, now that's no longer the case. You can sit in a T-bill and get 5%, which is amazing. And banks haven't raised rates that much, but you can get more on your bank deposit now than you could a couple of years ago. And so what that does is it gives you a way to sit in something very safe and have the optionality to use that in some kind of either a big sell-off or some kind of an event. And not only that, but what having cash will allow you to do is it will allow you to sleep at night a little bit better. And if we do get into a crisis, it will, because you have cash already and you don't need to sell something that's now under pressure, you will be able to make a decision better. You won't be as stressed when making decisions. And that decision you make when you're not stressed may make you a lot more money than if you were sitting in something other than cash right now. And so I think it makes sense for everybody to have cash in their portfolio. Again, what percent, it depends on personal circumstance, but having a 10% cash position seems extremely prudent to me.
Yeah. Well, I want to end on more of a lighthearted question. And I'm looking at you, and you have a map of the Camino de Santiago behind you. Santiago Capital, of course, named after the Camino, which I know you've been on. My mom has walked it several times. My dad's walked it a handful of times. My brother did it. And, we're getting into summer. We're going to go into Memorial Day weekend. And I would love to just hear about that experience, how it impacted you, because you named your firm after it. And if you want to share with folks the benefits of walking the Camino.
It was is one of the greatest experiences of my life. It was I was between jobs. I figured that was probably one of the few times in my life where I would have the time to do something like that. So for those who don't know, the Camino de Santiago is an ancient pilgrimage route. It goes all over Europe. The heart of it is in Spain, and in Western Spain, in an area called Galicia, is where St. James was buried. So Santiago is St. James in Spanish. And when they found his tomb, they declared it a holy site. This is, 1,000 years ago. And, pilgrims started going to this site. And so, but people still do it today. And so all along the way, you walk through wheat fields and along highways and through little towns, and you stop and you stay in these little places called pensiones. It's basically a bed, maybe a mat on the floor. Maybe they have a shower, maybe they don't. But I would say it's beautiful in its simplicity, because all you do is you get up and walk, and you just walk from one little town to the next town. And I did 520 miles. I started just over the border of Spain and France in a place called Saint Jean Pied de Port. And so I walked over the Pyrenees, which was pretty difficult for the first couple of days. And then you head west and you just keep walking. And it's interesting because you meet all different kinds of people along the way. There's a lot of people do it. It's become a very big event. But what I found amazing about it was not just the different people you met, but you had a lot of time to just sit there and think. There would be mornings where you would wake up and your feet, when you go to bed at night, you can feel your heartbeat in your toes because your feet are just killing you. You become an expert on fixing blisters very quickly. But every little town you go through, somebody will wave at you or they'll offer you a bottle of water. And it was a great experience. And, there's something to be said for the simplicity of it, because, like I said, some mornings you wake up, you don't want to walk, but you just start walking, and within an hour, you kind of find it a little better. And by the end of the day, you're glad you did it. And, when you walk into, Compostela, so Santiago de Compostela is the final stop. There's a big church, a big cathedral. And it's very emotional, right? It's because, a lot of people do it for different reasons. Some people do it for religious reasons. Some people do it for athletic reasons. Some people do it for not necessarily religious, but spiritual reasons. I actually just got a book. My wife got this book for me. Right here. It's
Oh, wow.
And Andrew McCarthy walked it with his son, and he wrote a book about it. Andrew McCarthy was an actor back in the 80s. And my son's 14, and we've kind of talked about doing it at some point. So anybody who's interested in doing it, I can't recommend it enough. It was a fascinating experience. Very I don't know the right way to say it. I can't really describe it other than say it was amazing.
Yeah, transformative, I suppose.
Transformative.
Well.
I think that's a good, and I did it before I started my career on Wall Street. So maybe when I'm done with my career, I'll walk it again. It'll be the bookends.
I love that. And do that with your son. That would be so amazing. Well, Brent, I have to say, I love having you on the show. I can't even tell you how many notes I took. Wait, a lot. And I always learn from you. And I know you help our viewers and listeners learn and get better and think about new things. So I just want to give you a quick moment. If you want to share where folks can find you on social media or follow you, if there's anything you want to plug or any parting thoughts that you'd like to share, please take a moment to do so.
Sure. So my regular day job is I manage money for very high net worth individuals. I have a website that just has my contact information, which is santiagocapital.com. If anybody's interested in, how we go about that, I'm happy to talk to them. I'm pretty active on Twitter. Santiago AU Fund is my handle, but if you just search Santiago Capital, there's a seashell on there. That's my handle. I'm pretty active on there. I do a number of these podcasts. We have our own show, which we call Milkshakes, Markets, and Madness. If you go to milkshakespod.com, you can get some more information there. And I'm always happy to come back and talk to you. I enjoy talking to you. And to the extent people find it helpful, I'm happy. This is part of the reason I do it, is to kind of help give back and help people who maybe don't have the ability to kind of figure this stuff out on their own.
I love that. You are always welcome on this show. Brent Johnson, thank you so much for being so generous with your time, your ideas, and your knowledge. Really appreciate you coming on.
Thank you.
Hey everyone, I really hope you enjoyed that video. Be sure to hit that like button, the subscribe, and that bell so you won't miss any new videos.